Hello guys, welcome back to my channel. This is Matrixfx. So this is the part 2 of a 4 series video. So if you haven't watched the part 1, I'll suggest you go back and watch the part 1. I think the link will be in the description also. So in the part 1 we talked about my trading journal. I think let me open that up. Yeah, in the part 1 we explained everything here. So the part 2 now we are going to focus on the technique and example, like how it's supposed to look like with a line chart. So if you can print this in your head, it will assist you. If you can understand it this way, it will assist you when you now go to the other with candlesticks, because as you know, candlesticks can be confusing at times. So let's start, guys. So I think, yeah, this is where we're starting from. Now first we have the sweep technique. Now in the sweep technique, what we'll be expecting is for price to be going to our POI. That's what we call it in the SMC world, POI, point of interest, but ICT calls it liquidity level. So price will be going to our POI, our liquidity level. When price goes into it, as you can see, price taps it. If it's an order block, it has tapped the other block. If it is a short-term high, it would have formed a double top right here. It would have formed a double top right there, and after the double top, it swept all the liquidity above that. So for those of us coming from the SMC world, we already understand what liquidity means. But for those who don't understand, if you go back and watch the first video and you still don't understand, I have a link in the description there for where ICT explains it himself, and I think you understand it better there. So as you can see, the market trades to our order block or our previous day high and low, sweeps the liquidity above there, and we get this break of structure, this sharp break of structure, break of this structure right here, this sharp break of structure. Now when we get this, immediately we know from an SMC trader, you know that what we just observed is a shift in market structure. So the market wants to shift. Now in this break of structure leg, you quantify from this high right here to this low to get your 50%. I think the 50% will be around here to get your 50%. Now you now start looking for your fair value gap below the 50%. Start looking for your fair value gap below the 50%. So this is, I think this is 50% line. Let's just leave it at this. So you now start looking for fair value gap below the 50%. So what we're expecting is for the market to pull back from here, tap into those fair value gap, and continue going higher. So that's what we're expecting, guys. So it's as simple as that. Guys. So what we're expecting, let me go over it again. Market is going to your expected level, taps it. Now immediately taps it, you wait for the market to break structure, to break this previous high right here. This is a swing high. This right here is a swing high. So wait for the market to break it. If the market doesn't break it, then we're not taking the trade. So we wait for the market to break it. Once the market break it, then this our break of structure leg right here, you quantify it to get your 50%. And this is very important because, like I said in the previous video, if you are buying, which is in this situation, you are buying, you want to be buying at discount. So anything below 50% is discount, anything above 50% is premium. So we'll be expecting the market to pull down back to discount before going back higher. So we'll be entering from the fair value gap. Our stop loss will be here. Our target will be, I think, nothing less than 1:3 RR. So it will be something of this nature. Entry, stop loss, and let's just assume this is your take profit right here. Let's just assume, sorry about that. Let's just assume this is your take profit right here. So you make sure that this is up to 3 RR. So for those who don't understand what 3 RR means, it means 3 risk to reward. That's to say, if you are risking $1, you should be getting $3 back from the trade. You should be getting $3. So for every $1, you get $3. So that is my minimum, guys. So that's my minimum. But for those of you who have watched the video, if you can recall, I talked about the 3 RR here, nothing less than 3 RR. So for those of you who haven't watched the video where I went through all this, you can just go back and watch it for your own sake too, and for mine. So like I said, So when the market taps into it, the market continue. Make sure this is a fair value gap, because the 2022 mentorship is fair value gap entries, like a fair value gap explanation, a fair value gap kind of entry. So that aside, let's go to the next. So in the sell situation, the sell scenario now, it's almost the same thing with the buy scenario, just inverted. So the market is coming to our POI or our liquidity level, taps it right here. This is the liquidity level, taps it, comes back, break the structure right here, pulls back. Remember, you have to fib this, you have to use your fib tool or your Ghana's box. I think I will show a video of how I set my Ghana's box also. So when the market trades back, since we are selling, remember, when we are selling, we want to sell at premium. So wait for the market to go back to premium, which is above the 50% level, before going down. That what simply means your stop loss will be here. Your stop loss will be just above this structure, just as it will be below the structure in a buy scenario. So your stop loss will be just above the structure, with your take profit down here. So I think that's that, just like we talked about in the buy scenario. So remember, the market is coming to your liquidity level, taps that, break structure right here, then you fib this leg, break of structure leg, you fib it. As you can see, I labeled it here, break of structure leg. Look at it right here. So break of structure leg, you make sure the market, when you fib it, you get your 50%, you make sure the market goes above the 50%, then you sell. So this will be your SL right here. Sorry about that, guys. Your SL right here, then your TP below. So it will be entry, SL, and TP. So that's for the sales. Now there is one other kind of technique, which is the failed technique. Now the failed technique is kind of complicated, because I just use my experience from SMC to form my failed technique. Now for those of you who have seen the sweep technique, it looks like chalk, change of character. For those of us coming from the SMC world, it looks like chalk, change of character. So the difference there is that I think we'll be entering off of the fair value gap, but you know that in the change of character, you are entering off of another block, and the change of character, we expect it to happen in another block, but this one can just be after a sweep of liquidity, then we see it and we can take that trade. Now for the failed one, like I said, it is kind of like a new one that I'm testing. I've back tested it and I'm using it currently. So what it simply means, what the failed technique implies is, for example, the market is coming down to your POI or your liquidity level, the market taps it right here. So this mostly occurs when the previous sweep point is too high for the market to come and break it immediately. Although it doesn't mean that the market can't do that, the market can actually do so. But if the market doesn't, when it taps our liquidity level right here, you now start seeing it giving this kind of weak move, this kind of weak move. So what you do is that we don't take this trade, because most times in liquidity, for us coming from the SMC world, you know that this is trendline liquidity, but normally SMC, we don't see that as trendline liquidity. Most of the time we see that the market going our way and we call it order flow, and we take the trade and it end up being a losing trade. But some people don't share. I don't know how you guys trade. For those of you who are coming from the SMC world to the ICT world and are encountering my channel, so I don't know how you guys trade, but when I used to trade SMC, that was how it was for me. So when the market comes and start giving this very weak move higher, so what we're expecting is for the market to pull back and create a failed low. Now the failed low will not break this low, to just pull back to clear out all this liquidity before breaking structure. Now in this situation, this is your new break of structure leg, not this one, to be your new break of structure, because this one also cleared liquidity down here, but it failed to create a new low. So I think this is getting a little bit messy, guys. Let me wipe that and continue. So the market now comes back, sweep the liquidity of all this trend line right here, sweep it. So this is your new structure. As you can see, I'm taking the market to break the new structure, then pulls back into the 50% of that new structure. Clean this. So once the market sweep the liquidity, breaks the new structure, that's when we fib the new structure, fib the new leg, the new break of structure leg, to get our 50%. Then we expect, after fibbing it, we will expect the market to go back to discount, then continue higher. Now there's one downside to this particular technique. Now the downside being that when you take the trade here, your SL will be below the sweep, that is below the leg that actually tapped into your liquidity level, which is this leg right here. This is where your SL will be. So as you can see, I annotated the triangle there. The triangle, I annotated it there. So you can see the annotation. So this is where your stop loss will be, right here. So not with the new structure, not with the new structure leg. Your stop loss will be below the new structure leg, below the sweep of liquidity, so that in case the market pulls back, and let's say there's another fair value gap below the one you took, which is the one below 50%, it can still come back, tap that one without taking you out, and continue higher. So I think in the next video, when I'm explaining it in the chat, I will show you an example of where this happened to me. So that's that. So you make sure that your stop loss is below this level, and your take profit nothing less than 1:3 RR. Now you see this failed technique, it is actually the same thing with the sweep technique. The difference is that since I'm using the lower time frame for entry, this particular failed technique might form the sweep technique in the higher time frame, and I don't use the higher time frame for entry. That's why I actually formed this technique. So I don't know if somebody else has formed it, but it was just from my collection of data that I used to, I think, get this. So as you can see, this was the supposed structure, the one that we're supposed to expect. But since the market gave us a new structure here, this is our new structure, and this is what we'll be working with. So that is enough for the buys. Now in the sell situation, it's the same thing. The same thing, guys. It's actually the same thing, just inverted. You can see the liquidity level. So the market is coming up to it. As you can see right here, the market taps it. So instead of the market to break the structure, come back to, let's say, the 50% or below and sell off, the market now starts doing something like this. Sorry about that. The market now starts doing something like this. So what we'll simply be waiting for is a failed high, this push, to clear this liquidity, because you know trendline liquidity traders will be expecting the market to tap this liquidity line again and continue going down. So sometimes it works for them, sometimes it doesn't. So we'll be expecting the market to clear it and create the failed high. So if you notice, the failed high will not take out this high, it will not take out that high. So the failed high, which is now our new structure, wait for it to break before we confirm that this is a failed high. You don't just see a move up and say this is the failed high. No, you wait for the failed high to break before you confirm that, okay, yeah, that's the failed high. Now once we've seen that the failed high has actually formed the failed high, it has broken the structure of the failed high, we measure the fib. Guys, we get the fib level of the failed high to get our 50%. Now some people do measure their fib from here down to this level, but sometimes the 50% might just be above this your structure, and you notice that the market will pull back into the 50% of this range and continue, and you'll be like, you missed the trade and stuff like that, and you start lamenting, that you missed the trade, this, that. So this is the right thing to do there. So what you actually do is you use from here to here, which is your new range. When you get it, you get the 50%, then you wait for the market to trade back to premium before selling off. So I think that's all, guys. In the next video, guys, I'll be explaining it in the chat. So we are going to the chat in the next video. So feel free to like and subscribe if you enjoyed the video. Thanks for watching. I'll see you guys later.